What's up, y'all? So another follow-up to my liquidity crisis videos. Liquidity crisis is difficult to explain, so that's why I have to take a lot more time explaining it. It's an easy concept when you think about it, but when you start talking about it, there's just so much involved that it takes 2, 3, 4 videos to get it done. But I mean, if I were to do it really simply, just think of yourself as a bank, right? And you're running out of money to pay your bills. So your parents would be like the central bank, right? If you ever needed an emergency cash inflow, you could go to your parents and be like, look, I'm having financial troubles. I need your help. And so can you give me a quick cash influx and I'll pay you back later? And your parents would probably help you out because they're your kids, or you're their kids, and I mean, most parents, right? Especially in America today, because the millennials are living with their parents. So you'll see a lot of that where the parents will help the kids out when they're in trouble. Well, central banks are kind of set up that way, and they call themselves the buyers of last resort, right? So what are the banks? The institutional banks, the Chases, the Wells Fargos, the Bank of Americas, what are they doing? They give out loans, they give out loans, they give out loans. And then what do the banks do? When you give out money, you have that credit risk that I talked about. So the banks don't want that kind of credit risk. So ever since Bill Clinton did away with Glass-Steagall and instituted Gramm-Leach-Bliley, the institutional banks were able to combine with investment houses, whereas before they weren't allowed to do that. An investment broker was separate from a bank, was separate from a commercial bank, right? Now you can go to Bank of America and they have their Bank of America Mutual Fund investment service there, which is supposed to be a totally separate business, but now it's all combined together. And what happens when you have investment houses with the banks? Well, the banks don't want the credit risk, the default risk from the loan. If they give you money and you can't pay it back, they're in trouble, right? They're on the hook because they lost their money. You have the money in pocket, they don't. So what's the best way for the banks to get out of that? Well, they go to their investment house. The investment house creates a security, a new contract, right? A mortgage-backed security where they can take all the loans that they've given out for mortgages, let's say, since I brought up mortgage-backed securities, and they'll combine all the mortgages together and they'll put it into something that they'll call a bond, right? A high-quality, high-yield bond. And then they pitch it to investors, and the investors just look at it as a bond without even really understanding what's behind it. But the bond is really just the mortgages. And so when an investor comes and they invest in that bond, they give money to buy that bond. Well, who are they giving the money to? They're giving it to the bank. So now the banks have the best of both worlds. They've lent out money and they're making interest on the loan. And now they've transferred the default risk to an investor. So the bank gets compensated. So they're actually not even lending out their money anymore because the investor gives them the money back. So usually when you give out a loan, you're giving the money to somebody else and they have to pay you back. And if they default, you lose the money. Well, the banks are now lending money out and then the money's coming back in immediately into their pockets. And they're compensated. They're fully compensated for giving out a loan. So they're basically making free interest on that loan. And they're paying a little bit of interest out to the investor, but they're pocketing most of it as profit. It's free interest. It's unbelievable how smart their financial engineering is. However, it's only smart as long as people have the earnings capacities to keep paying their bills. So if businesses are going out of business, like we're seeing regularly today, and people are getting laid off from their jobs, which is their main source of income, or sometimes their only source of income, there's no more income to pay the bills when they have loans. So when that loan statement comes in and it's like, it's time to pay your bill for your month, and they don't have a paycheck for that month, there's no more servicing that loan. And so the banks will lose money in that regard. So the banks still have these loans on their balance sheets, right? Even though they've turned them into bonds and they've sold them off to investors. So when the default starts to happen and the investors start to lose money, the banks still have that losing thing on their balance sheet, and they don't want that, because at the end of the year, if it shows that the bank is losing a lot of money in their investments through their investment arms, it hurts their stock. And then investors who go into the stock market and want to buy shares of Bank of America, I'm just using Bank of America as an example, but they're not the only bank that does this. All the banks do this. Then the investors will punish the financial shares, right? So you'll look at the financial industry, the whole sector will start to crash. So that's why real estate, for example, when they give loans out and the real estate prices collapse, you get major losses in the financial sector. So what happens? The banks need money. Where do they go? They go to daddy or mommy bank, which is the central bank of each country. And they complain and they say, we're losing money. We need help. And so the central bank is the buyer of last resort. Now, you have to consider, where does a central bank actually make their money? They don't make money in reality, because they are a quasi-governmental organization. I don't even like that word quasi, because in reality, they're not even governmental. They're just a private bank, private shareholders. And they align themselves with governments, and the governments do all their work through the central bank, which is totally, totally bad. It's a bad setup. People should not be supporting central banking systems, because we get this whole situation where they lend money to our governments, they set the interest rates for our economies, and then the taxpayers have to pay back that money. Because again, government doesn't make money either. The only way government gets money is by being a parasite and sucking it off of the taxpayers, because the taxpayers are the ones working. The government doesn't really work. They just do paper shuffling. They don't really produce anything. They transfer bureaucracy. They transfer paperwork from one end to the other. And so then the government has to borrow money from the central bank whenever they need to do some kind of project, like military spending or something else like that. The president creates a bill, Congress approves it, and the president will sign it, whatever. And then, or the Congress creates a bill, the president will approve it or veto it. And if it's approved, then they need to get money. They go to the central bank prints it. And we're borrowing our own money. And that's why our system shouldn't be on a central banking system. But anyway, the central bank is the buyer of last resort and lender of last resort. So when the little banks are like, I got all these bad assets on my balance sheet, it's coming towards the end of the year, we need that Santa Claus rally. Remember in the last video I talked about the quote Santa Claus rally? And I put it in quotes because it's like a free gift. Because the reality of it is the central bank is playing Santa Claus. The central bank comes in and they do something called quantitative easing, where they print money, ones and zeros, not necessarily on paper. I mean, it can be on a computer. And they then take that newly created cash, which is basically just sucking the value of our own money from our pockets, because that money wasn't created by any production of value. It was just created out of thin air. So the value that needs to go into that newly created cash is taken from the old cash that's in existence already. And then they give that cash to the banks, the institutional banks, in exchange for their securities or their bonds, their mortgage-backed securities or their collateralized debt obligations. Whatever it is that they've bundled in there, whatever debt they've bundled together and created some kind of false bond for investors to buy. And then that way it keeps the market alive, because the investors may want to sell out of it, and you'll see the price of those assets plummet, and there's no one there to buy it because it's a big selling market. And so the Fed will come in, or the central bank of another country will come in, and they'll buy up that, like the European Central Bank will use the exchange stabilization fund, the money that's set aside for that purpose, and they will buy up that special purpose vehicle or that mortgage-backed security. They call them special purpose vehicles because this special purpose is to remove the bad stuff from the balance sheets of the banks so that people will still continue to invest. And then you get your Santa Claus rally before the end of the year, which is all short-term. It's all short-term stuff. Although they've been able to keep these markets alive doing that, as people catch on to that game's going to end. Because eventually all the money gets sucked out of the system and it gets concentrated in the hands of the wealthy. Because only the wealthy understand this process. The poor people keep spending. And businesses keep going out of business because money is not treated with respect when it's turned into credit. And we are a debt-laden society. So now you're seeing all around the world they're having financial problems. Right now they're talking about Italy and China. So all the markets around the world are crashing because of them. So you can bet that you're going to have the central banks come in and start doing their easing eventually. They're going to start taking the money off of banks' balance sheets. Or in the case of a government, if the government is bankrupt, like in the case of Italy, where their bonds are going bad, then you have the International Monetary Fund come in and lend a government money in exchange for all of their sovereignty. So that's what's happening in Greece. It's happened in Greece multiple times. The International Monetary Fund, headed by Christine Lagarde, who doesn't want anyone to be self-sufficient, wants them to be a slave, in other words, because anyone who doesn't take care of things themselves is slave to somebody else. The International Monetary Fund will come in and they'll lend money to the bankrupt government in exchange for what's known as austerity measures. Austerity means financial discipline. Well, if you have financial discipline on your own, you don't need someone else to come in and instill austerity on you. You're already austere. You're disciplined in your finances. So you don't need to borrow money because your finances are shored up. You've managed your money well. But Greece didn't. Greece was spending. Then the IMF came in, bailed them out. Spending. IMF coming in again, bailing them out. So the IMF is this giant mafia organization that comes in and just takes over countries. And it becomes communistic, or actually fascistic. You know, it's a different type of socialism than communism. It's a fascist type of government where the corporation comes in, takes over the government, and then the corporation is now making the laws and the rules of the nation instead of the people being able to vote on it. And the communists like to use that example as a reason why we shouldn't have capitalism. We shouldn't have corporations. We should be in a communist situation. But the reality of it is communism and fascism are the same thing. It's either the government owns the companies or the companies own the government, but either way, the government and the companies are all the same. You go to China, communism, the only ones who own businesses are the government officials. All the multimillionaires and billionaires are government officials. You don't hear the average citizen in a communist state having money. Average citizen can barely survive. The government just provides enough food for them to eat. And then the government creates little special economic zones in China where they allow certain businesses to happen only if you're a friend of the government. And those people make some money. But the majority of the people are starving. They're poor, they're bankrupt, they're struggling just to pay their bills. And the government just provides enough food so that they don't riot. So don't let the communists con you into thinking that capitalism isn't the way to go. Even the communists in China know to make special economic zones, which are small capitalist zones, to allow wealth generation to occur. Without capitalism, you have no wealth generation. And with too much capitalism, you have fascism, because then the corporations get too wealthy. And you start to get where you get crony capitalism, where they start to favor their own kind. That's why you need to have a mixed type of economy, where it's a little bit capitalist and it's a little bit socialist, but it's just the right mix. And we all have to be knowledgeable about it and make sure it stays within balance. Because if it gets to sway one way or the other, we end up slaves in our own country. So this is the liquidity crisis in short. All right? You guys have a good day. Keep your eyes open. We may have crashes coming, but I don't believe that's going to happen yet. I believe the governments are going to bail out some way, form, or other. All right. Take care.